There we go. Hey everyone, I hope you're all doing well. I hope you're all having brilliant, fantastic, amazing days. Welcome back to another video. Today, I've got the secrets to passing prop firms. Okay, this is the video title for today. And the reason for this is because I've noticed a lot of members inside the community have been struggling to get across the line lately. Okay, the current market conditions have been choppy. It's been a tough market to trade, but in particular, people have been overcomplicating things. Okay, they've been perhaps incorporating loads of different strategies. Okay, they've been taking different levels of risk on each trade, and they've been consequently, struggling to get across the line. They might have been making nice, steady, small profits and then taking a big chunky loss. So I wanted to discuss this today to perhaps break it down into a more simple mold. So what I've written here as the main argument is that simplicity is key when it comes down to taking these prop firm challenges. Okay, whether you're incorporating expert advisors or manual trades, whether you're doing both, more of a hybrid approach, simplicity is key. Okay, and not changing the strategy every single day, every single week, sticking to a mold, sticking to a structure, okay, and running through with it for the full month. Okay, because market cycle is going to happen. Okay, you're going to get more luck in certain weeks and other weeks you're not. But in general, if you know the strategy that you're taking has an edge within the market, stick with it. Okay, stick with it and run it through. Run it through for the full month. Okay, and of course, if you get a free retry, brilliant, and then you can change it up. But at least run it through for the the 30 days or the 25, 24 trading days that you have. Okay, don't be changing it up every single week. Okay, so that's the first thing. The second thing that I've written down here is that prop firms are best passed when calculating risk per trade. Now, what do I mean by this? I'm going to do a lengthier video on how to calculate risk per trade for manual trades in particular, because I've also noticed that, some people have been struggling to differentiate this between different instruments. Okay, and, as and when they increase or decrease their stop loss, working it out, they're not as fast as they need to be able to do this effectively. So that video will be coming out in the next couple of weeks on how to calculate risk per trade manually, quickly, efficiently, and so that as and when you're increasing or decreasing your stop loss size, okay, perhaps altering your risk reward ratios, exactly how much you're going to make and how much you're going to lose in a given position. So what I've written here is calculating risk per trade. Okay, it needs to be done. It has to be done. And one of the strategies that I've used that's worked really well is making it really basic. Okay, so sticking to a 1-to-1 risk to reward ratio trade, okay, and risking 1% per trade. Okay, so it's 1-to-1 risk to reward ratio, keeping the stop loss the same size and the take profit the same size every single time, and sticking with the same lot size. So consequently, on a $100,000 account, you're going to lose $1,000 per trade, and you're going to make $1,000 per trade. Okay, and then ultimately, throughout your 24, 25 trading days, okay, that as long as you've got a winning level of trades, okay, as long as you've got above a 50% win rate, you know that you're going to be banking profit. Okay, now this is of course slightly different when it's the challenge and the verification, because you've got to get across the line. But when a live funded account comes around, if you've got this strict, discipline, bulletproof structure where you've got a 1-to-1 risk to reward ratio trade, okay, 1% risk, $1,000 loss, $1,000 profit, then as long as you've got a win rate above 50%, then you're going to be taking home money every single month. So what I've said is stick to the basics, especially when practicing this. Okay, try a 1-to-1 risk to reward ratio, okay, for 30 days with 1% risk per trade. Okay, you can take 1, 2, 3 trades a day. Okay, don't take any more than that because you're probably over trading, but give it a try. Whereas if you've got some trades that are 0.25% risk, some that are 0.5, some that are 1, some that are 4% risk, okay, you might have loads of winning trades and it might look really nice and blue inside your terminal dashboard, okay, but you're going to have 1 or 2 losses and it's going to wipe out that entire profit, okay, and that entire progress and journey. And that is not an effective and efficient way to trade long term. Okay, it might bank a little bit of profit in the short term. You might be able to hedge out of trades. You might be able to dollar cost average into trades and make some money. Okay, but when it comes down to it, trading consistently over the long term, okay, you need to have an edge in the market. You need to be disciplined with it. So I've said to a lot of people inside the community that stick with a 1-to-1 risk to reward ratio, trade, every single trade. Okay, and as and when you can do that and do that confidently, then you can perhaps tweak your risk to reward ratios, maybe have a 2-to-1 or a 3-to-1. Okay, but to start off with, have a 1-to-1 risk to reward ratio trade, risk 1% or risk 0.5% and stick with it. Okay, and do it for 30 days. If you've got more winning trades than losing trades, you'll make money. Okay, and that will help build confidence, reassurance that you're actually knowing what you're doing and you're getting better. And it's a good little hack and a good little tool that I've used to, build confidence and get, accounts across the line. And it's also been a really good and effective strategy for myself to get accounts across the line and to also secure profits and payouts on the live funded accounts. So ultimately, give it a shot, give it a try. Let me know your thoughts. Comment down below if you've found it successful and helpful. But ultimately, what I've written here is simplicity is key to passing in these prop firms. A lot of people are overcomplicating it. So essentially, if you can win 10 more trades than you lose in a given month, risking 1% per trade, then you're going to get an FTMO challenge across the line. Okay, and that's 8 trades, more than you lose from my Forex funds account to get that challenge across the line. It's even easier for the stage 2. For both of them, you only need to get, 5 more winning trades than you do to lose to get the verification across the line. And then you're on the live funded account. So when you break it down like that, okay, and you go 1-to-1 risk to reward ratios, 1% risk per trade, it makes it a lot easier and a lot more manageable. And, seems a lot more realistic to get across the line. So I hope that's helped. Let me know your thoughts down below, and I'll see you in the next video. Bye for now.